DocuSign stock is down more than 80% since the pandemic, but shares may have hit bottom. They're up 47% since the beginning of November after the company posted better than expected earnings. At the latest share price, the company has a market cap of $11.7 billion, account for cash, debt and investments, and the enterprise value is $10.7 billion. Revenue over the last 12 months has grown 11% to $2.7 billion, and net income is positive at $52 million. At 14 times free cash flow, DocuSign stock looks extremely reasonable. However, 80% of that free cash flow comes from stock-based compensation, which is excluded from free cash flow as it's a non-cash expense. Adjust for that and DocuSign is really trading closer to 70 times free cash flow. That valuation might be reasonable if DocuSign was growing quickly, but it isn't. Revenue growth has slowed from 52% in 2017 to 49% during the pandemic to only 11% this year. Even worse, billings, which measures the amount of new business that's coming in, should rise just 7%. Clearly, the pandemic hasn't changed the way businesses operate as much as DocuSign shareholders thought it would. All that said, the stock is finally showing some strength. Lower interest rates should provide a boost to real estate deals, and last quarter's adjusted earnings were better than expected. The company also discussed the move into CLM software, which stands for Contract Lifecycle Management. This is a good move which will allow the company to capture more revenue from its customers. But DocuSign has been pitching this expansion for years. More than 5 years ago, the company spent $220 million to acquire CLM platform Spring CM, and yet there's been little growth to show for it. The CEO even admitted that CLM represents a small contribution to the overall business. Meanwhile, competition is a major concern. Adobe is a clear rival in e-signatures, having integrated it into its cloud products. Salesforce and numerous other companies have launched CLM platforms as well. If DocuSign can get back to double-digit growth, then the stock will be a clear winner, but that remains a big if. Like pandemic winner Zoom, DocuSign's products may be useful, but they're not particularly difficult to replicate. Low barriers to entry and lack of competitive advantage means this business will find it difficult to truly outpace its rivals. For these reasons, I give this stock a negative rating, but these are my personal opinions, not financial advice, and I hold no position in DocuSign stock. For more investing videos, visit my website 3minutebreakdowns.com. Thank you for watching.